Defiance just started a new set of index ETFs with a different strategy than their QQQY, JEPY, and IWMY ETFs. But are these new ETFs worth investing in? Let's find out. This video is not financial advice, nor is it a recommendation. Please do your own due diligence before investing into anything. Thus far, only SPYT is currently trading, but they're working on getting QQQT and IWMT on the market as soon as they're approved. These new ETFs are designed to be the opposite strategy of the other set of ETFs. When you invest your cash into these funds, they either buy treasuries or direct shares of an ETF that tracks the index. Then they sell a call option at or near the money and buy another call option for the same expiration, but this call is out of the money, meaning a higher strike price. Because this call is out of the money, the price of that call should be lower than the premium of the call they sold, creating a spread which gives them profits. This profit pays for the dividend. The call strategy itself is a bearish strategy. When you sell a call option, your hope is for the stock to drop or trade sideways and remain below the strike price. In light of this strategy being bearish, these ETFs would work best when the underlying index trades sideways or goes down. Of course, with any actively managed ETF like this one, you'll also have a high expense ratio. For these funds, the expense ratio listed on the prospectus is 1.05%. Now that we've covered the basics, let's look at the pros and the cons. If you're not very experienced or don't understand the options market, these ETFs are a way to get professionals to do this for you. You won't have to watch contracts fluctuate in price, and you won't have to worry as much about being able to hop on your phone to quickly trade out of a contract. Another advantage of ETFs like these is the broad market exposure. Each of these ETFs trades against an ETF that owns the entire index of stocks rather than just one single stock. That adds an element of diversification that can help mitigate risk. Lastly, the option strategy of this ETF being a bearish one makes these ETFs a type of hedge against downward movement of the market. Because the call spread benefits from sideways or slightly downward movement, a drop in the market can provide a better dividend payment. That said, the fact that these ETFs gave themselves the flexibility to buy direct shares can also provide exposure to the capital gains from upward movements in the underlying index. Now that we've covered the good parts, let's look at the disadvantages. While it is easier to let a professional handle your trades, you also lose the control that comes with doing it yourself. Of course, because you're getting active management, you're also paying a higher expense ratio. Do you own these ETFs? If so, which ones do you own? If you like this video, you might also enjoy this one here on the screen. Subscribe to join the Cash Flow Club and hit the bell for notifications so you don't miss a single video.